Podcast is now starting. All attendees are in listen-only mode.
Hi, everyone, and welcome to today's NCAT ATTRA webinar, Organic Farming and Crop Insurance Options. My name is Rich Myers, and I'm an outreach specialist for the National Center for Appropriate Technology, which is kind of a mouthful, so most people just know us as NCAT. NCAT's a nationwide nonprofit organization. We're based in Butte, Montana, and we have 5 regional offices across the country. We work on issues pertaining to sustainable agriculture, sustainable energy, and sustainable communities. Part of this webinar will be based on recent results from a 5-year National Organic Research and Education Initiative project titled, Is Organic Farming Risky? And we appreciate OREI's support in researching such an important topic, as well as in helping spread the word about the project's results. And so you know, and so you can tell other folks who might be interested, this webinar is being recorded, and it will be available on NCAT's ATTRA website. ATTRA is a sustainable agriculture information service that's funded through a cooperative agreement with the USDA Rural Business Cooperative Service, and we're grateful for their support as well. ATTRA offers a wide range of services to sustainable agriculture producers, including publications, toll-free helplines, podcasts, videos, and webinars. And you can check it out for yourself after this webinar at the ATTRA website, www.attra.ncat.org. That's www.attra.ncat.org. And today's presenter is Jeff Schahczenski, the Agricultural and Natural Resource Economist for NCAT. He works out of NCAT's headquarters in Butte. And Jeff has expertise in organic and sustainable agriculture public policy, marketing and economics, genetically modified crops and agriculture, organic horticulture, renewable agricultural energy, cooperative development, sustainable building, intercultural communications, and beekeeping. He was also the executive director of both the Big Hole River Foundation and Western Sustainable Agriculture Working Group. He has worked with the Alternative Energy Resources Organization on regional sustainable agriculture projects, has been an adjunct instructor for the University of Montana, Western Montana College, and Montana Tech, and served on several nonprofit boards of directors. Before moving to Montana, Jeff worked for Rutgers Universities, started one of the first community-supported agricultural farms in New Jersey, received graduate degrees in agricultural economics and political science. He served in the Peace Corps in Belize, and worked on his grandfather's dairy farm in his native Wisconsin. There are a couple of things I'd like to point out before I turn it over to Jeff and we get started. First, you'll see a field on the screen where you can write questions during the webinar. I'll be collecting the questions, and Jeff will answer a number of them toward the end of the webinar. And I just wanted to say, don't be shy about asking questions. If you ask a question and it isn't answered during the webinar, we will answer it and all the questions via email in the days to come. And also, at the end of the webinar, you'll receive a short survey. Please take a few minutes to answer it. It helps us make future webinars as effective and helpful as we can. So, okay, I think it's time to get started. So let me turn things over to Jeff.
Thank you, Rich. Good morning, everyone. I'm Jeff Schahczenski. I'm an agricultural and natural resource economist here at NCAT for many, many years. I've been working almost 13 years on the topic of crop insurance. That might seem incredible to many of you, but I have. And my motivation really has been for sustainability, improving crop insurance so that it will genuinely support sustainable and organic agriculture, and particularly to perhaps reward diverse cropping systems that go in conjunction with the potential of sustainable systems of production. The second motivation has been to lower public costs. On average, 62% of the premium costs for all crop insurance policies in the United States are paid by taxpayers. It's quite a hefty cost, and I've been exploring ways to perhaps make that less expensive for the public. And I have a particular focus on a product we will be talking about today called whole farm revenue, which is very different, and in its sense is ensuring the whole farm's revenue. And the idea here is that if insurance can provide a way for a farmer to continue farming. I mean, in insurance, a farmer could lose his entire farm to weather or a flood or something. And if we focus on revenue rather than just the yield of a crop or the particular crop, we might actually keep farmers farming. So I'm going to talk about the history of organic crop insurance, which isn't too long, and then very briefly. I'm going to look at the basic benefits and limitations of crop insurance generally for organic farming, particularly, and what organic farmers and livestock producers say and know about crop insurance. Part of our project has been to do a survey, and I'll present a bit of the results of that survey of 1,500 farmers nationwide, organic farmers in particular. Again, I will talk about whole farm revenue protection as a means to support all sustainable agriculture, large and small. Many people think that whole farm revenue is only geared to smaller farms, but actually our experience and the data that we have gotten in our research has shown that actually very large farms are using it as well as smaller farms. The benefits and limitations of whole farm revenue protection, and a more general question: can crop insurance promote diverse organic and non-organic cropping systems at lower public cost? And remember, please take the survey at the end of the webinar. That will be very helpful for us. So the history. In 2001, the first crop insurance policies were written for certified organic farms. That's a little bit surprising. I think folks might have thought that was a longer period of time, but really until the Organic Production Act was implemented fully in 2001, there really wasn't a specific emphasis on ensuring farms that were organic, because we didn't really have a national organic standard at that point until 2001. Today, some 18 years later or so, 19 years later, we have 67 organic crops insured nationwide. We have 8,430 organic policies sold in 2017, and this represents approximately 30% of all certified organic farms. And if you compare that with just the number of farms totally that have insurance, only 16% of farms in general have insurance. So actually organic farmers tend to use crop insurance a little bit more than non-organic farms. We have over 1.2 million acres of organic insured, almost $1 billion of organic value. Liability is the value of the crop insured, and that was almost $1 billion in 2017. And the premiums, we had almost 90 million in premiums being paid by organic farms. And in that year, we had 143 million, almost 144 million paid out, or indemnities. So the payout of an insurance policy is referred to as an indemnity, which I might use that term, but now you know what it means. So I'm going to break the history a little bit in centering around the last farm bill. I know we just had a recent farm bill, but much of the information about what's new about that for crop insurance is not quite settled yet. So I'm going to use 2014 as the kind of date for looking at the history. So since the good news, since 2014, 5%, so we had 2001 to 2014. So 5% organic premium surcharge was dropped. Prior to 2014 in the Farm Bill, just if you were an organic farmer and you were taking out crop insurance, you simply had to pay 5% more in a premium just because you were organic. And I think the logic of that is that there was an assumption that organic farms are riskier than non-organic farms, which is the very topic we've been investigating for the last 4 years now, almost 5 years. Another thing called the contract price addendum was made available for organic products, and that's available today to 66 crops. The contract price addendum is a way in which, if an organic farmer is insuring, then they can actually get up to a certain maximum. They can get their crop insured at that contracted price. And so that's available for 66 crops today. And it's a very good, I mean, if you have a solid contract with a buyer, then you can use that as the price, as the basis of your insurance, and therefore you can really truly cover that value that you in fact will have in your crop. So that's a very important addition. Again, and whole farm revenue has a long history. It was originally, before 2014, was called adjusted gross revenue and adjusted gross revenue light, which I've spent many years working with. And in the 2014 Farm Bill, that was changed to a product that's very similar to those earlier products called whole farm revenue protection. And it was released in 2015, and it was the first crop insurance policy to be available nationwide, meaning that you can buy this policy in any county, in any state in the United States, and that's not true of any other crop insurance policy. In 2014, 16 crops had organic price elections, and that means that they made a calculation as to the value of an organic crop, largely based on the non-organic crop, but that at least that gets it closer to the value. So you have two choices. You can either go with the price election that RMA has determined, or through the contract price addendum for the contracted price that you have. Either one of the, and each has a maximum. But by 2018, 79 crops actually had organic price elections, and by 2018, RMA has actually reviewed all the crops that are currently insured under the crop insurance program, and they have organic price elections except for 19 of those, which they probably just don't have enough data on yet to be able to provide a price election for those crops. Bad news since 2014. There's something called an organic transition yield. And really all it is, or a transition yield in general, is really the average yield of a particular crop in a particular county. And after 2014, the organic transition yields, these are the average yields, were basically limited to 35% of the comparative non-organic yields. Now this is really important really for the beginning organic farmers, or the farmers who have not established a yield history for the crop they grow organically. And when you don't have, and for all crops, organic and non, you need at least a 4-year history to establish an actual production history yield based on your farm. If you do not have that history because you're a beginning farmer, then what you do is you in fact you use that county yield as a substitute for it. So essentially, because there's no other real data, they just use that county average as a substitute for that. And in 2014, they basically said across the board, across all major crops that were insured, they just said they're going to only give you up to 35% of that if you use that as your proxy for your actual production history. So, you know, and there's a big argument about whether that's legitimate or not, and appropriate or not, and we really do know from research and other things that it's likely that not all crops are 35%. The county averages for organic are 35% less, but it was based on some data, not particularly great, but that's the way it is right now. So that's something that I think we can work on as data becomes more available, and there's been quite a bit of data collected since 2001 and the first crops were insured. And the other thing that's important to note is that organic price elections, remember I talked about those earlier, those are the other price you can use to insure your crop if you don't have a contract, are really entirely based on non-organic crop prices. So for example, here in Montana, where we grow a lot of wheat, organic continuous cropped winter wheat, its harvest price is simply the non-organic harvest price, and that'll be the ultimate basis of the indemnity should there be a loss. The harvest price times 2.164, which in 2018 was $11.79 a bushel. Now, this 2.164 is rather arbitrary and is making the assumption that organic wheat prices and non-organic wheat prices are somehow tied together in a relationship of 2.164 differences in price in the year of 2018, which we know is not true. By looking at the data historically, there seems to be very little reason why the organic wheat market should behave anywhere similar to the non-organic wheat market. Very different markets, but this is the best they can do, again, possibly because of insufficient data. Some more bad news. The organic price addendum, while great, is again also based on the non-organic price. The maximum contract price, for instance, for again this continuous crop winter wheat is $10.99 per bushel times 1.5, which is $6.49. So even if you had a contract, let's say for $18 a bushel for winter wheat, you would still only be able to insure it for $16.49 a bushel, meaning that you essentially were underinsured for the value of that crop in the insurance year. And there's just this maximum. I'm not quite sure why that maximum is set that way. And again, it's very much derived off of the non-organic market, which it does not necessarily follow the organic market. Whole farm revenue protection is not being used extensively by organic farmers, and we'll talk about that a little bit more. Only 3.7% of all the whole farm revenue policies of all the policies, only 3.7% were sold in 2017, which is rather disappointing for me because I had a hunch and I had thought, working on this, that organic farmers might be more interested in this policy than they appear to be. The good news since 2018, and so we have had a farm bill, and the farm bill has just been passed, and the new farm bill does require the USDA and the Risk Management Agency, which directs all federal crop insurance programs, to have listening sessions, in particular to improve whole farm revenue, and we're going to be participating in that along with many other groups around the country. So there is the possibility there will be some changes. The other thing that was a big change is that the Federal Crop Insurance Corporation now defines a beginning farmer as 10 years or less of experience, which is very consistent with USDA. For some reason, before this farm bill, RMA assumed that, used the definition that had to be 5 or less years of experience was a beginning farmer. So now it's consistent, and that means that's an advantage because at several policies, including whole farm, there's premium advantages. They give a discount for farmers that are beginning. That means they can take advantage of that discount now for up to 10 years. Some basic problems before I get into some specific policies is that this map, for all crop insurance, there's limited geographic availability of policies for most crops. Now, if you're talking about corn and wheat and soybeans, they're pretty extensively available throughout most counties in the United States. The unit of analysis for crop insurance really is the county. When you want to speak about what's available or what's the price or all these things, it's really very particular to your county. And so for specialty crops, there's just not a geographic availability. There's certainly a lot of crops that have crop insurance policies that are specialty crops, but they're not always available everywhere. So the example here, and you can barely see them, is the little green dots you see, those counties. That's where cabbage insurance was available in 2018. And it wasn't very many counties of the 3,300 or so counties in the United States. There were very few. And even amongst those very few, there's not always an organic equivalent policy. So for organics, it's even sometimes even less likely that there's going to be a policy available for many of the specialty crops, even though we can say, yes, there is organic cabbage insurance somewhere. It's just in very few places. And the other issue that has been always, and why whole farm and what we will talk about has been kind of interesting, is that the more diversified a farm is, let's say a farm is growing 20 different things, it's pretty hard for a farmer to both have a policy available for every crop and to insure every crop independently. So in a sense, whole farm was created to get around this idea of insuring each individual crop separately. And of course, that would even depend on whether it was available. I mean, here in Montana, I can grow fresh market tomatoes, but I can't insure them as fresh market tomatoes, either organically or non-organically. I can insure them, though, with whole farm revenue, and that's the beauty of whole farm revenue. So it has a great potential, whole farm, to provide insurance for all the crops that people grow in the United States in every single county, but there are some important limitations which we will discuss shortly here. So other information is crop-specific policies are available or not depending on which county you live in. Again, I'm just reiterating that there's no organic fresh market tomato policies in Montana. And really, we get calls a lot, and I can figure it out. There's a way to go onto the RMA website, and you can figure out whether in a specific county, what kind of crop insurances are available, what types, and for which products. But in general, I think it'd be best to check with the insurance agent because they should know the area in which they work. Or you can call us at ATTRA, and I've gotten many of these calls, and I can look it up for you. One thing we're thinking of in the future is training people to use the RMA site so they can find that out for themselves. But the information is there. It's just a little bit hard to find. All federally supported crop insurance policies are subsidized. That's something to remember too. Every single one of them. They vary in the level of subsidy depending on the crop, depending on the location as well. But on average, as I said earlier, it's about 62% of the cost of a premium is paid by taxpayers. All crop insurance agents that sell federally subsidized crop insurance must provide for the sale of all approved types of policies offered in a particular county. So we've found that sometimes folks don't know about whole farm revenue, for instance, or they don't know about maybe about an obscure crop, and an agent may not know or it hasn't worked much with folks that are organic, or haven't worked much with folks that want to use a whole farm perspective. And so, but legally they're obligated to. They're called an independent agent can work for several crop insurance companies. And remember that the crop insurance is kind of a joint private-public relationship. Essentially, the government, Federal Crop Insurance Corporation, and RMA they provide the policies that then agents serve and provide as agents in a particular location. So they're basically servicing the policies and selling them, and they make money on that servicing, and they also share in the risk. So when there's gains, it's called underwriting gains, they get some money for that. And they get a pretty good, they get some good value for providing that service and doing that work. So they're required to just remember that, just keep asking. No crop insurance policy ever provides 100% of a loss. That's just something that we should know. And even though it varies by type of crop and type of product, it's getting better for certain crops, mostly the commodity crops, the larger 16 commodity crops that are kind of the major ones in the United States. They can even get these what's called supplemental crop options, and in many cases, and they can get up to pretty close to 90%, 95% of loss of the value, if we're talking revenue, of the revenue losses, which is a pretty good coverage. Now, of course, that's going to cost more. The more protection, the higher the cost. So in our project, one thing we wanted to do was to get a better perspective on what organic farmers thought about crop insurance generally. And so we did a survey in 2017 over a pretty long time. This is just a graph of the responses. I'm not sure why in October we got some more responses, but we used all kinds of ways. This is not a random sample. It's not a perfect statistically accurate sample. We basically used like a rolling methodology where we just try to contact through all our links with people, through the National Organic Programs Integrity Database. We tried to get out to contact all farmers, all organic farmers that we could, and we offered a $20 fee for them to take the survey. And it took a while, but we got quite a few surveys back. Some of the basic questions we were looking at: why do small, organic, and diversified farms choose to buy or not buy crop insurance? And what are good and poor targets for educational campaigns? We were trying to find out information so that we could better educate and figure out where the education is most needed. That was partly the reasons for this survey. 1,300 producers started it, and only about 1,042 actually finished it, became the sample. I'm only going to go through a few of these. We're going to have a paper, and we're going to have some stuff on our website that'll give more details. We had some 45 questions, so I can't have the time to go through all of them, but I picked a few that are kind of interesting. This is one question we asked: for the long-term success and survival of your farm or ranch, how important is it for you to have crop insurance? And it's kind of an even distribution across all the people that answered, from not important at all to extremely important. And I guess if you put the slightly moderate and slightly moderate together, I mean, it's important for a lot of the people that answered this survey and a lot of organic farms. Now, this one is actually more interesting, we think, in that we were trying to get a sense of how much people understood, again, through these educational and outreach programs we're going to do later. And this basically is a scale from 1 to 4, and 1 means I know nothing. So you see on the left-hand side, I know nothing, all the way up to I know a lot. And then you see in the last in red the weighted average for those things, and you can see that none of them reach 2, which means they're a little, they're basically I know a little and I know nothing is about where most people lie. And these are such issues as what policies and products are available? Do you know the crops that are available in your specific county? Do you know what the RMA does? Do you even know what RMA means, or the risk management agency is? Whole farm insurance, we were particularly interested in that. And again, that was fairly low. Insurance designed specifically for organic crops using premium prices, again, that was very low. The options of using a sales contract, or the contract price addendum, as the RMA calls it, was again very low. So a lot of education to do among organic farmers about crop insurance. And so again, we're particularly interested in whole farm revenue protection, and so we asked this question. And no, I'm sorry, this is not the survey anymore. I'm moving on. And so I'm going to now talk about whole farm revenue. Again, crop insurance for individual crops is basically similar, other than that the price election and the contract price addendums are open to you, and there's some limitations in terms of the geography where you could buy individual crop policies for organic crops. So they're pretty much the same. Now, whole farm is significantly different, and we had the hopes and thought that organic farms might use this product more because of the limitations of availability geographically and a more close price to the actual value of the product they're selling. So whole farm provides insurance based on your approved average historic gross revenue with a minimum of 5 years of history, unless you're a beginning farmer, which now is 10 years or less years of experience, in which case you only need 3 years of experience to buy a whole farm revenue policy. Again, anywhere in the United States, in any county in the United States, it can be bought, but you have to have 3 years of experience. So that is a limitation. That means that the very starting out, you can't get a whole farm. But if you think from the point of view of the government and insurance, without a history or some experience, it's pretty hard to set a premium to know how risky it is for you to grow a crop. So 3 years is pretty good. And there's another product that Farm Service Agency provides called Non-Insured Crop Disaster Assistance, or NAP, and you could use that possibly as an alternative. Revenue, and I think that this is really important. I've heard many people talking about whole farm revenue, and they forget about the revenue in the whole farm revenue. And revenue is simply the quantity times price. And what that means is that revenue is kind of the Cadillac of crop insurance, because it basically protects against two kinds of risks. The risk of the market price of your product changing within the year you grow it, and that can be significant for different crops. And obviously anything that affects the quantity, which crop insurance people talk about as multiple perils, like drought, like flood, like wind, like insects and pests. That affects your quantity or your yield. And so revenue being quantity times yield, you basically encapsulate in one product, risk associated with two different areas of financial risk. And that's a significant advantage. And that is why on single crop policies across the United States, both organic and non-organic, like for instance wheat, revenue insurance is by far preferred amongst people insuring crops because of that advantage. So what is whole farm revenue again? We're still going on. Deductible is at best 15% of the historic approved revenue. And a way to think of this, a simple way to think of this, is that no loss payment is paid until your historic average, you drop in the year of your insurance, you drop below 15% of your historic average, which means you really have, the best coverage you can get is 85% coverage level, which means the farm has to be able to withstand a 15% loss of the historic revenue that it gets, which, may or may not be, survivability or not. I mean, it's not perfect, but it's certainly better to have 85% of that historic than nothing at all. And of course, you can buy at lower coverage levels so that you can lower the cost. You don't have to buy the highest coverage level. And whole farm provides for livestock product production, again, up to a certain limit of dollars. And one can use whole farm revenue and other crop-based products at the same time. In other words, if you were growing wheat, corn, and soybeans, and you want to take out a whole farm revenue rather than buy an individual policy for each one of those crops, let's say your corn was, like 80% of your revenue historically, and the other ones were only making up 20%, 10% each. You might want to put a policy on your corn that's individual revenue, and then maybe take a whole farm policy out for the rest of the farm. So in other words, you can mix and match the policies. And in fact, we've found some evidence in our research that some people are using it exactly that way. They're basically insuring their most valuable crop with an individual policy, a crop-based policy, and usually revenue, and then they use the whole farm for kind of an overall insurance for the rest of the farm, which is the way to go and something you should check with your agent about. Why organic farmers ought to use whole farm? This is my hypothesis, I suppose, or what we all thought when we went into. First of all, product is less expensive if you grow 3 or plus products that are not covered by single crop policies. So in other words, if you were in Montana and you wanted to cover your fresh tomatoes, you wanted to cover your green peppers, and you wanted to cover your green beans, you can cover it with whole farm revenue. With 3 or more crops, I can get 85% coverage level. If I have 3 or less crops, I can't get that higher level of coverage. So if I have 3 or more crops, I can get a higher subsidy for my premium. And And as you even increase beyond 3 or 4 or 5 or 6 crops in your whole farm policy, you get even a premium rate discount in addition to the fact that you get the high subsidy with 3 or more crops. So so basically the product incentivizes and gives a discount to farms that are more diverse. And this is what really drew me to this from the very beginning, was here is a policy that tells the farmer, grow the combination of crops that you find most profitable, will protect your revenue over time, and you can figure out what you need to, to do to maintain your profitability. And if you grow more crops in a diversity, which we know should make the farm less risky, in a sense it's resilience, then we should charge you less. And if you think about it, this is where we get to the public cost. If everyone were using whole farm revenue, and they were actually diverse farms in the United States, the subsidy would be less because they would essentially have less risk and less likelihood of actually crashing, and therefore less public cost of the subsidy, because of the diversity itself would be a form of insurance. Additional significant premium subsidy depending on level of coverage. And I said it varies from the level of coverage, so you get that premium discount. And you can mix and match, as I said before. The other advantage was, of course, which is logical, it automatically captures the historic organic values of the products you sold in the past. So you don't have to do this contact price addendum. You don't have to have a price election. You have embedded in your revenue of your farm, if you've been farming organically for 5 years, you have the value of your organic crop embedded in your revenue. And therefore, it is in fact, giving you close as it possibly can to ensuring the actual value of that organic crop. And even products that, and the other thing, it does crops that can't be insured in any other way. Under the categories of crops, when you put a policy together, there's an other crop option. So if you're growing something that is not available at all under federal crop insurance, like lavender, for instance, and you're growing lavender as part of your farm, you can list it as other crop, and it can be insured under whole farm revenue. And that can also be done for livestock products. So again, this is something very unique, this other crop category, which really does, promote specialty and diverse cropping systems that we had assumed might be interesting to more organic farms. And there is some suggestion in the research that organic farms generally are more diverse in their crop and livestock systems. Partly that's a reflection of the rules of being certified. You need to have crop rotations. Many times crop rotations are part of your fertility management, and even if it's fertility, it's still a commercial crop. So in general, one would argue, one might say that organic farms on a given comparative are generally more diverse, and again, therefore, a whole farm might be of more interest to them. Now I'm going to do an example of how whole farm revenue works, and I'm going to use Santa Cruz County, California. Again, the county is the basis of the unit of analysis. I chose Santa Cruz because I'm actually going there next week to talk about crop insurance, and wanted to get prepared for that, but also thought I love California. My wife's from California. I know Santa Cruz, the city, really well, and it's a beautiful little county right against the ocean there. And California generally has more specialty crops than a lot of other states. In fact, it has the most different kinds of individual crop insurance policies of any state in the union, and but they also have just a wide variety of specialty crops. And this gives you a sense, these crops, the strawberries, the apples, the wine grapes, the Brussels sprouts, the lettuce leaf, this data comes from the Santa Cruz 2017 ag statistics. The counties in California do annual statistics of their agriculture, and so these are very these crops are picked deliberately because they're the most commonly grown in Santa Cruz County. And the prices are actually the accurate prices. These aren't made up numbers. These are numbers that actually reflect the prices that were received by farmers in Santa Cruz County in 2017. And you can see that strawberries is a very high value. This is just an 8-acre farm, and you can see that it expects. We're going to pretend like we're expecting it to have this revenue so we can do a crop insurance. It expects that it's going to make $140,000 on this 8 acres with these 5 crops. And their historic revenue, based on their tax reforms, that's the other thing, that all the calculations are based on tax reported forms, so it's accurate information from your farm. So with a 5-year historic average revenue is about 130. So they're expecting to do a little better. Now, an important point here is that whole farm revenue insures on the basis of the lower of the actual revenue for the insurance year, or in this case, the $140,000 number, or the $130 number, the historic average. In this case, the average is lower, the historic average is lower, so that will be the basis of the premium and the basis of the payments. And it is possible, this is generally the case, although it is possible that a farm could be just growing less than it did historically, and then in which case that lower number would be used as the basis of insurance. Loss of 50% revenue. So now I'm going to just play the game. Let's just say for whatever causes, both price / and/or drought, too much rain, floods, whatever caused it, the farm had a 50% loss in its revenue from what it expected to have. So with whole farm, the expected revenue, again, was $140,000. The actual revenue with a 50% loss is $70,000. The liability coverage, that means the value being insured, is 85% coverage level is 119. That is of 85% of the 130. Remember, we use that lower number as the basis of that. So that's the coverage. The indemnity payment for this policy would be 119 minus the 70, the actual revenue. So with this 50% loss, the farm could expect to get paid $49,220 in a loss payment. And that added to their actual revenue would be essentially what they would then get with the insurance. So the net payment minus the actual premium cost. So the premium cost for this policy for that value is $3,841. The farm then gets a $45,000 net payment added to their actual revenue is what they actually get for that crop year with the recovery from the insurance. Now, what would be the alternative for this farm in Santa Cruz County? Besides no insurance, obviously. The strawberries, there is a policy called actual revenue history. It's a revenue-based policy, and you can get 85% but its premium is $4,076. So already you can see the advantage of insuring the whole farm. The premium just for strawberries alone is more than $1,000 more than but it's more. It's more, not $200 or $300 more just for one crop. Apples, they only have for apples in this county. They only remember, different products are only available in certain counties. So in Santa Cruz County, only apple yield insurance, what they call actual production history insurance, is available, and it only provides 75% coverage, but the premium isn't too significant. It's $407. And then the wine grapes again, has a yield only insurance, so you don't get the revenue protection, and it's $270. So the total premium is $4,756. But note that Brussels sprouts aren't insurable because there is no policy for Brussels sprouts in Santa Cruz. So in this case, the whole farm does better because it covers all of the crops. It is a lower cost policy. It provides a fairly high level of coverage, and it's in some sense a better alternative than paying these individuals and then even having some of your crops uninsurable. I wanted to give the same example, but with only 3 products rather than the 5, to show you why having a more diverse farm matters. So in this case, we're just going to have a strawberry, apple, and Brussels sprout using the same numbers. And the farmer is also a beginning farmer, so we can show you how that discount works. and that's, again, less than 10 years of farming experience. The expected revenue in this case would only be $111,000. The 5-year historic revenue is obviously less. It's just 3 crops. The liability coverage, again, is of that 97. We use the lower of the two, and the coverage is $83,000. The actual revenue lose, and so again, we have the 50% loss. So they lose 50%. So they're only going to get $55,628 for their actual production. The farmer premium in this case is $2,439 for these products, much less than the other one, but there's 2 less products. And that also is embedded in that is a $718 discount for, in fact, being a beginning farmer. So the indemnity payment is the liability coverage minus the loss, $27,000. The net payment minus the thing is $25,000. The overall benefit, one way to think of this is you have the $25,000 indemnity payment, you have the $55,000 worth of crops, you have $80,000. So you expected a revenue of $111,000, and you, with crop insurance, you're again at the $80,000. Again, not 100% coverage, but a lot better than being at $55,000 only. And again, if we had done this with the 5 products, remember, that was $3,840, and that's just, if you just divide it, it's $768 per product. And with the 3 products, we have $2,000. The premium is actually less because there's less crops being insured, but the cost per product is in fact higher. So there's where you see the diversity. It's not a significant diversity factor, but it just keeps lowering at each crop you add, and then again by the level of coverage that you take. So how come organic farmers aren't? Now that we've made a case that it might be a viable and maybe even really good cost-effective way to ensure a diverse farm, why aren't they using it? Here's just some general statistics. We have gotten, in this project, we've gotten all the policies, data on all the policies sold, all the whole farm revenue policies sold between 2015 and 2017. And we have them broken down by organic and non-organic farms. So this first time this data, I think, has been widely publicly shown anywhere. And it is pretty disappointing in 2015. We only had 7 organic farmers nationwide that took out a whole farm revenue, where we had 1,000 total policies sold, or 0.6%. Gets a little better in 2016. By 2017, it's up to 104. But still, look at that, only 3.7%. And I am struggling now to understand why that is true. I have some ideas, and we'll talk a little bit about some of them, and some of them I don't know. And I would appreciate any of you on this webinar who have their own ideas about why this might not be working for diverse and organic farms of all sizes even. Let me know. One thing is, we don't think that that reason organic farmers is they don't really understand the diversity benefit, the benefit of actually having a lower cost policy with reasonably high coverage at a reasonable cost. They just don't really know that that's a function of it. They haven't really experimented thinking about whether that would be good for their farm. And one thing, this is an analysis of all the policies again from 2015 through 2017. And if you look at the one axis, we have the number of policies sold, but on the bottom we have the number of commodities per category. What that means is that there are whole farm revenue policies sold, and you can buy whole farm revenue even if you only grow one commodity. You can buy it. You can't get 85% coverage level. You can only get 75% coverage level, and you do get some subsidy for that, not as high. But anyway, we can see that if you look at, we have 1 commodity whole farm revenue policies. We have 2 commodity or 2 products. They can be actually livestock or crops. 2 product policies. We have 3 product policies, and you can see the number of policies in those categories. And if you take really whole farm policies over the last 3 years that were insured with 4 or less crops, that really represents the bulk. In fact, you can't see out on the other end. There was actually a farm that had 30 crops that took out a whole farm revenue policy, but it was really only 1 over those 3 years. And those numbers diminished quite rapidly over time. Now, so why isn't that diversity benefit being, and maybe it's just knowledge. There's probably some there's a lot of different reasons, but it's a bit concerning. However, we think compared to the previous policies like AGR and AGR Lite, we have seen some improvement in diversity. And this is national data, and we do see differences among states. And not every state has sold whole farm revenue policies, but in states where there's more or less policies, there is a variation, and we see some states that have diverse agricultures using it a little bit differently than this national example. Some other reasons: need to have good historical records of your revenue, and need to determine accessible estimates for the insurance year of revenue. You have to sit down with your agent. You have to determine in the year of your insurance what, you have to have good historical records. You have to have your tax forms. You have to have at least 3 if you're beginning, or 5 years of historical records to buy the policy in the first place. And then in the year of insurance, you have to say, this is what I expect to get for this crop, the price, and this is the yield I expect to get, and you have to justify that. You have to justify that with your own records, or you have to justify that with some third-party independent data, but you have to come to an agreement on the value of the crop that you're producing in the insurance year. And we have heard that that is not always easy to do, particularly for crops that aren't well known and don't have any historical data on. And it can also be a very conflictive kind of situation between the agent. The agent needs to be secure that that's a realistic price and that's a realistic yield. And so there's a bit of negotiation going on there, and there are some rules about that. And we won't go into the details of that, but we can talk about that, and your agent should be able to explain that to you quite well. There's lots of forms to fill out. At the beginning and during the insurance year, through the year, you have to, for instance, you have to be saying, what are you going to produce at the beginning of the year? If something changes in the middle year, you have to fill a form out if there's a change. And at the very end of the year, you have to say what actually was produced and at what cost, so that they can make a judgment. That's a lot of work. But the other argument on the other side, if you're not keeping really good records, if you're not really, have good historical records of your costs and your yields, that's really important to viability of a farm. So, in a sense, I always argue that whole farm kind of pushes you into being a good record keeper, which is really a good thing, I think, ultimately for people. And a lot of these forms go beyond, I think, what is necessary, and that's what we're going to be talking about in this new 2018 Farm Bill in the listening sessions. We're going to figure out ways to maybe back down on some of this unnecessary paperwork. We think there's a little bit more paperwork than is really needed. And besides, it's really not that much different than other crops. Particularly if you grow 3 or 4 commodity crops, you still have to keep your approved revenue history. You still have to take out policies for each 4 products. I mean, it's relatively easy to renew if you do grow the same crops, but there's still paperwork involved in all crop insurance. Another thing is applicants are required to provide an accounting of the historical expenses. So not only do they have to have an accounting of their historical revenue, they have to have a historical record of their expenses, which is available, again, on your tax form, so it's not that hard to get. And it's set up that if you in your insurance year do not spend on your expenses, on your at least 70% or more of your historical expenses, then your indemnity will be lowered. It's a kind of a penalty. And the only reason I think they have this is that they're afraid that people might be gaming the system, and therefore they want to know that you actually expended expenses on your insurance year, so that you didn't intentionally cause there to be a loss that was not due to the regular, either the price or to the weather or whatever caused that loss. Now, what's interesting, though, no other insurance policy that's sold in the United States requires an expense verification. And so we have made a recommendation and to RMA, and we'll be pursuing this, that we drop that as a requirement of this policy. Whether that will happen or not it takes time to work through public policy that way. Government payments and subsidies are not counted as a farm's revenue in the calculation of the historic revenue. So any of your direct payments or any of those things, they don't count because they're arguing that only the actual revenue generated by the crop itself, not because of a subsidy, should be included in your real production history of revenue. But on the same time, when you're calculating a loss, they add them back in. So that makes your revenue appear higher, and then your deductible therefore lower. We think this is inconsistent, and we are proposing to eliminate that problem as well by basically either doing it. We don't care if they use payments, direct payments, as part of your historic revenue, and then as at the end. But it seems illogically inconsistent to do it, not to do it on one end or the other. That they should do it consistently across the farm. This is probably the most important reason. The beginning farmers, in particular organic farmers, applying for whole farm may have highly volatile adjusted gross revenues. I mean, when you're a beginning farmer, your revenues, your whole farm revenue for the first 4 or 5 years of farming, when you're ready to take this policy out, or 3 years if you're a beginning farmer, those might be pretty volatile years. You're just learning how to become farmers. And if you have high volatility, your historic average revenue is going to be lower, which means that in the year where you're finally getting to learn, like that 4th or 6th year, you're finally getting to learn how to farm and you're having a higher revenue, then in fact, you're only getting your insurance based on your historical average, which is much lower than your current expected year, and therefore you don't get that same coverage. So in a sense, you're underinsured. And it's kind of crazy to do this when a farmer's beginning, because that's when they need the help from insurance, not to, in a sense, be penalized because of volatility. There are some trend factors that are already built in. So if you're moving up, you do get a bump up so that you don't have your straight historical average. Or if you can document a physical expansion of acreage of the farm, you're growing more acreage and more product, you can get that historic average increased up to 35%. You have to work that through your agent so that, again, you're closer, and yet that smooths out a little bit of the volatility. Crop insurance agents may not understand whole farm revenue. As part of our research, we did do a survey of all the crop insurance agents in the country. We didn't get an answer from all of them, but we got a pretty good sample, and we did find that there is a wide range of opinions about the value of this product, some that are very, very, very negative, and some that are very, very positive. So it's not clear, and we're not clear as to why some think it's very positive and some think the opposite. Another thing that we found out that might explain why we don't see the level of diversity among organic and non-organic farms and using whole farm is that when you look at the different commodities that make up a whole farm revenue policy, and these are all of the policies and all of the products valued at the level at which they were insured in that given year, you can see that apples represent, of all whole farm revenue policies for those 3 years, almost $2 billion worth of apples were insured over those 3 years within a policy that was a whole farm. Many of those might even be just apple. What we have found is that across the country, not just in Washington, although Washington is where this happens the most, people are using whole farm revenue to insure only one product, apples. Now you say, why? Is that true? Well, partly it's because the quality of the only other alternative that provides a revenue protection, again, revenue is important, quantity and price, then is whole farm. Also, historically, AGR and AGR Light was used by apple growers, and when they converted to whole farm, which is very much the same product, they really liked the product and used to using it, so they just renew it and keep using it. But this is not true of only apple growing in Washington, where a lot of our apples are grown. It's any place that our apples are grown. It's dominantly a lot of apple growers are using whole farm, even if they only have one. If they're only growing apples, sometimes they might be growing other fruit and they might combine them. But the other thing that's very interesting about this, and you can see that it drops very quickly in terms of the different crops, so they're spread a little bit more evenly around. All the things in red are what we might call our commodity crops, And you would think with very good and very readily available revenue policies for those crops like wheat, that one wouldn't be using a whole farm revenue product in their thing. But that's what we haven't really figured out. Maybe there's some advantage to cost, and the coverage is pretty good. So we're finding that even in Iowa, where you'd think people would just take corn or soybean revenue policies out individually, many of them are finding if they're growing a diversity of commodity crops, maybe they're growing corn, soybeans, wheat, flax, or something unusual, even if they're organic or not, and they find that they can incorporate that corn into the whole farm policy. Some take-homes. Organic farmers use crop insurance generally more than non-organic farmers. Over the last 17 years, there's been great improvement in the way organic farming, not perfect, but organic farms, they have really done, I think, a great work at trying to serve the organic community well, RMA has, and I'm certain that many folks and many organizations have worked hard to see that happen over the years. Whole farm revenue has great promise to support a wide range of organic crops and livestock products nationwide, and it's ideally suited for relatively diverse farms. Maybe farms that are greater than 3 and less than 10. Maybe not the highly diverse farms, because all those things have to be, the record keeping, it could become a nightmare. And many folks we hear when they get up to many crops in our direct marketing feel that their diversity is their insurance and they really don't need a whole farm revenue. But if you're in that middle and scaling up range, this might be an ideal product for organic and non-organic farms. Whole farm can provide affordable revenue insurance for all crops and livestock everywhere. That's a really important point. You know, if there, just because there's just for specialty crops in particular, you know, there's just not those individual crop policies available. Again, the cabbage example. You want to grow cabbage, you have a great market for cabbage. If you're not one of those counties, you can't buy an individual policy, but you can buy a whole farm revenue product. The other take home, surprisingly, organic farmers aren't using, and we're searching and trying to figure that out. If you have some insight, please write me. Whole farm is not incentivizing or supporting cropping systems diversity as fully as expected. And then we're seeing that apples and monoculture and biculture and triculture farms are using it more than maybe farms with 8 or 9 different crops. And though, while not incentivizing as much as it might or could, it really does, it seems to be improvement over historically what AGR and AGR light policies did. There's more farmers of a diverse nature using it, we think, than historically have been. So it's moving in the right direction. Future improvements to being considered: limit the complication by removing reporting of historical expenses. I mentioned that. Better and more education on the affordability and the incentives of production system diversity for whole farm. I think we need to really drive that point home. Decrease impacts of the volatile revenue by replacing extreme loss years with historic. We have this again, this 35% if it's an expanding farm, indexing if the revenue is going up so that you don't stick with your strict historic revenue. Another way, which is very similar to what they do with individual crop policies, is they will take a really bad year and they will put the average yield or revenue in for that year. And if we did that for whole farm, we would again smooth and raise that historic average up so that it was closer to the actual insured year. And that's something that could be done, and there's a precedent for it in actual single crop policies. The other thing I think is just more researchy, but I think is important, that we begin really setting premiums of organic policies separately and use actual organic data rather than just base them on non-organic crops. These are distinct markets with distinct properties and with distinct risks, and perhaps rating these policies, setting premiums distinctly based on that data as more and more is accumulated, and 17, 18 years of it's being accumulated, we should be able to do this. End or lower organic crop T yields. Again, base them on actual organic data as soon as possible. Remember, I said if you have to use those T yields and they're automatically 35%, you're definitely going to be uninsured as a beginning farmer. And if we actually had organic-based T yields that were more close to the actual and not just an arbitrary 35%, then that would be an improvement for those transitioning. In a way, this will take care of itself, because ultimately your actual history will become your actual history. So this problem will go away as farmers get into their 4th or 5th year, but this might be a specific barrier, particularly those transitioning to organic farming. And again, provide agents and adjusters. Adjusters are the people who calculate the losses at the end, with more and maybe better education on organic production systems. Again, there's not as much knowledge about the distinct nature of organic production systems than there should be. So questions? Hey, Rich, are you there?
Yep, I'm here.
Okay. Do we have thousands of questions?
Well, but we have a good question here about the history. It says, does the history need to be with a specific production type, like transitional history or organic history, or is all history considered to be equivalent, the same?
You only use the transitional here is history when you have no other data available. So in other words, let's just say a very beginning farmer who never farmed, and I don't even want to do it organic or not. You're just starting out, and you're just going to grow corn to make it easy. And you're going to grow 100 acres of corn. So you have no history of growing corn. So what they do is they say, well, we'll insure based on the historic average of corn in your county. That's what will insure that basis. And they'll do that for 4 years. Well, no, then you'll actually grow one. And so then you'll have an actual history. So that second year will become your actual history. And then it'll become the average of the 2, plus the 2 other years filled in with the average. Then you'll have the 3rd year of real. And eventually you'll get to 4, and then past, and when you get up to 10 years, it starts to roll. The average starts to roll over. And it's just basically, as your revenue history gets documented more and more accurately, that becomes the basis of your insurance. That's for a single policy. For a whole farm, it's very different, because you're really looking at the revenue of the whole farm over time. And again, there's nothing like a whole farm T yield. There's no average whole farm revenue for a farm in any county. So that doesn't really apply in this case. But the revenue, the premium is based on, from your tax forms, your historic revenue, which again could be volatile, could be trending up, could be expanding with the farm. And there could be really, in the volatility, could because there were really bad years in there, and we might substitute bad years with average years so that we could get that actual history more close to what you're actually insuring in the year that you're finally getting to be a good farmer. I think that helps with the answer. I hope so. If not, send another email and I'll get back to you.
Okay. Well, there's another question here about livestock. Excuse me. Does the diversity discount of whole farm revenue protection also apply to livestock products, or
Yes.
value-added products, like, if you're making maple syrup or
No,
something like
it
that?
does not. There's no coverage for anything. In fact, if your tax record includes value-added products as part of your revenue, those have to be taken out of your historic revenue, your historic taxes, because this is only ensuring production of farm commodities, not value-added products. So that's one point. And what was the first one? I already forgot.
Talking about the diversity discount of whole farm revenue with
the
livestock.
Livestock products would count as part of your diversity. So you could have 3. I could corn, wheat. I'm just going easy ones. Corn, wheat, soybeans, and chicken eggs. And chicken eggs would mean you have 4 commodities that count. Now, a little bit of a trick there. All of those 4 products have to significantly contribute to the whole farm's revenue. If they're just a very minor project, and then when you do the estimation, that will drop out. They may not be a commodity to count if they're a fairly marginal part of the farm. But if they're a significant part, let's say that was 25% of your income came from those 4 different products, all 4 would count as your diversity. So livestock, yes. That's the beauty. Again, livestock are included. Now there's a maximum, and I can't remember the number, but you can only up to a maximum level of organic. Your livestock can't be I think it's more than $1 million. Don't quote me on that. But if you have more than $1 million worth of livestock products in the mix of the things that you're insuring, you're not eligible. There's also a maximum total whole farm revenue. So this is not for the largest gargantuan farms. It's effectively a $10 million limit. And that's 10 million because at 10 million, if you potentially are only growing one crop, then that's actually 85%. It's really 8.5 million, but theoretically, if you had one crop and you did it at the 80, you could go up to 10 million. So that's a big farm, but it's not a gigantic farm. And so there is a maximum limit to the people that can apply for whole farm. But a lot of farms have less than 10 million gross income.
Okay, there's several questions on this topic, so I wanted to ask you this before we go. If the crop insurance agencies in your county don't have experience with organic farmers and insurance, can you work with agents located elsewhere in the state, or are you limited in that way?
Oh, no, not at all. The independent agent, there's many different independent agents. It's a bit confusing, but there's only 13 major companies that work with the federal government to provide federally subsidized crop insurance products. They're called AIPs, Accredited Insurance Providers. And kind of like other insurance, there's independent agents who can sell different products from all of those AIPs. And there are actually a few, like hail insurance, that are purely private. They can sell those too. So it's like shopping for any other kind of insurance agent. There could be different ones. Some might have experience with organic farms, some might not. And of course, it's a burden, but if it's 3-4 counties over, there's one that has an experience, you can use them on the RMA locator, and I can get that for you, the person. It has a very good, it's a brand new website now recently. It's a very good, it actually gives you a GPS map of all the crop insurance agents located near you, how far they are away, whether they speak Spanish. There's a very good locator system on the RMA page that will, you can shop. So, and definitely shop around. You should feel comfortable working with the person, just like buying health or car insurance. You want to trust your agent. You want to believe he's working in your best interest. He or she, knows your situation. So yes, shop around.
Okay. Well, we are a little bit over the time for the podcast, so I think we'll have to leave it there. The webinar, I'm sorry, but some folks have sent in some questions really recently here, and I just wanted to reiterate that if your questions weren't answered during the webinar here, that we will be answering them via email in the next period of time here.
And you'll probably get them from me, Rich, because I'm the one that knows the most about it. So we'll get those questions back in. You'll get an email from me for sure on all the questions unanswered.
And if other questions occur to you afterwards, you can get in touch with Jeff. There's an email address there on the bottom of your screen, the askanag@ncat.org. You can get in touch with Jeff through that. That's probably as easy as any. Or you can go to the ATTRA website there, the www.attra.ncat.org. And there's a feature called Ask an Ag Expert, and that you can get to Jeff through that as well. And we also have the hotline down there. So there's all sorts of ways you can get a hold of Jeff if you have other questions. And before we leave, we'd like to thank you for stopping by and listening to or seeing the webinar. And I just want to say, don't forget to fill out the survey, which will come up when the webinar ends. It really does help us out a lot. So you got anything to add, Jeff?
No, it's a pretty short survey, and it really will help. And if you curious organic farmers out there have insight as to why you might or might not like whole farm revenue, please send me that message too. Make it as maybe ask a question and then say, well, this is why it doesn't really work for me, because we're really interested in knowing and understanding why whole farm revenue doesn't work for organic growers, because we really have great hopes in it.
And it is sort of a complicated subject, and this, just so you remember, this This webinar will be on the ATTRA page down there, the www.attra.ncat.org, pretty darn quickly, so you can always review it and let other people who might be interested know it's there as well. So, got anything else, Jeff? I'd just like to say
thank you everybody for coming. We also have great publications, as you know, on crop insurance too. So even and on whole farm. So a lot of extra publications again. So you can read up on it if you want to read up more in details, even besides the webinar. And I even did a podcast that if you could listen to if you wanted to, that I did earlier on much of the same topic. So there's lots of different ways you can hear the same message, and I know you're all fascinated with crop insurance, just like I am now. So I appreciate your attention.
And you can find those other resources at the www.attra.ncat.org. So with that, thank you all for attending, and we'll end it now.